You are watching Macro TV. In this episode, we are still busy with the basic macroeconomic model. It's study unit 2, but we are starting with chapter 3 in Fourie and Burger. This is number 1 of 10 videos introducing the financial sector and working on the derivation of the so-called ISLM model. To start off this introduction to the financial sector, we basically want to elaborate on interest rates, which was left unexplained in the previous chapter. We now integrate analysis of the monetary sector with that of our knowledge on spending in the real sector. In this way, we hope to improve our understanding of short-run fluctuations in the economy. Now, real activities like consumption, lending, borrowing, investing, saving, and trading all require functioning financial institutions, and it's a familiar picture from the circular flow. We know that households send their savings to financial institutions and firms borrow from institutions in order to invest. Government also interacts with financial institutions, and our analysis of this monetary sector adds to the circular flow model. Now, the first important distinction is between nominal and real interest rates. Nominal rates are the rates that we see as consumers when we borrow money at the bank. The prime rate, for example, or even the rate that you earn on your savings account would be in nominal terms, also known as current terms. Real interest rates are the nominal rates adjusted for inflation. So it's the nominal rate minus the inflation rate gives you the real interest rate. Now, practically, these interest rates are determined in the money and the capital market. The money market handles instruments or financial assets that have a term to maturity of up to 1 year, and this is the short run side of the market. On the long run, you have the capital market where the instruments or the assets have a term to maturity of more than 1 year. When we talk about financial institutions, we are talking about commercial banks, investment banks, pension funds, insurers, and they basically act as intermediaries between people in the economy who have a surplus of funds and those with a shortage of funds. So the ones with a surplus of funds are the lenders, and they put their money with these financial institutions who then invest it on their behalf. The borrowers approach the financial institutions and they borrow the money from them in order to consume, invest, and all the other aspects of aggregate demand. When we talk about financial instruments, these are sort of financial paper or value paper, as it's also referred to, that is traded in the financial market. It's just a way of formalizing the borrowing and loaning of money that we talk about above. So there is some contract, if you would like to think about it that way, which says I will buy a financial asset from whoever issues it, and in return, so I give them my money, I, in other words, invest with them, and in return receive this financial paper, which pays a nominal interest rate. So the paper or the asset has a price, and as well as an interest rate attached to it. Now, these rates are determined in the money market. Now, the kinds of financial paper, or specifically in the money market, are so-called treasury bills, NCDs, or bankers' acceptances, the BAs. So you can read more about them in the textbook, but to briefly explain, if the government or the treasury wants to borrow money, they sell these treasury bills to people who have a surplus of money who want to invest it. So you buy the bill, you give them the money, you receive the bill in return, and while you have it, you earn interest on it, and you can sell it back in the secondary market whenever you want. The same for the NCDs, but they are issued by banks. Similar, the bankers' acceptances. So you have to get the idea that it's not just borrowing and lending of money between different accounts. There is a financial asset at the heart of this, and the interest rate that is earned and the price of that asset is what you see in the market. There's an inverse relationship between the price and the nominal interest rate. So if the price is high, the nominal interest rate is low, and the other way around. Now, what causes this interest rate to change? It's basically supply and demand for the underlying asset, the value paper. And we'll talk a lot more about this supply and demand for either money, cash, or for financial paper throughout this chapter. Now, there's a little example from the textbook that I can quickly talk you through. So let's say that there's some kind of financial asset. It's a treasury bill, NCD or a BA with a face value of 100,000 Rand and a maturity, in this case, in May 2011. It's short run, so it's only 91 days. We're looking at the money market here. So this gets issued, but the first thing to notice is that it's sold at a price less than its face value. So its face value is 100,000, but it's sold at 97,000 Rand. So whoever holds this value paper can, after 91 days, return it to the government or the bank who issued it, and they will receive 100,000 in return. So what is the interest rate that they earn? It's the 3,000 Rand that they get from the difference between the face value and the issue price, and you express that as a percentage of that initial price at which it was sold, and that gives you an interest rate of 12%. Now, if you don't want to wait 91 days to get your money back, you can always sell this treasury bill or NCD or BA in the secondary market. So selling it before maturity, you now sort of can go and sell your paper. You bought it at 97,000 and want to resell it at 98,200. So the new holder will still receive 100,000 at the end of the period, but of course, earn a slightly lower interest rate. They're holding it for a shorter period of time and they earn a lower interest rate than you would have done if you put your money into this instrument for the full period. Now, typically, this trade is not individuals. It's portfolio managers that at this level sort of manage their cash and invest in different kinds of financial assets. So if one of them has too much cash in their portfolio, their supply of money is greater than their demand for money. They decide they want to reduce the cash that they hold. They go and they buy financial paper. So they use the money to buy these financial papers. The demand for the financial paper means that there's an increase in the price, and due to the inverse relationship, nominal interest rates decline. The other way around, if a fund manager decides that they need more cash, they would sell their financial paper. This means that there's an increase in the supply of these papers, their price decrease, and the nominal interest rate increase. Now, to conclude, this was a brief introduction to the financial sector as part of the circular flow. We talked about money and interest rates, and all this are small building blocks towards the point where we can talk about equilibrium in the monetary sector of the economy. I want to encourage you to go and read through the textbook. There's a lot of interesting details there that helps you to understand how the whole sort of monetary sector works, and then we can later talk about how does this link to the real side or the spending side of the economy.